If you've been following China's economic policies, you've probably heard the buzz around debt resolution. Starting September 2024, Beijing rolled out an ambitious plan to tackle local governments' hidden debts, 12 trillion yuan in all. Today, we'll dive beyond the headlines. We'll explain what debt resolution really means, why it matters, and how it fits into China's unique fiscal landscape. Plus, we'll unpack the taxes, expenditures, and the infamous land finance model that birthed much of these off-budget obligations. Let's jump right in. First, let's clarify two crucial concepts. Explicit debt, obligations the government issues under its own name, recorded on budget. Implicit debt, off-budget or hidden liabilities, often raised by third parties on behalf of government units. By end 2023, China's combined explicit debt was about 70 trillion yuan, 30 trillion for Beijing, 40 trillion for local authorities, only 56% of GDP. That's moderate compared to Japan or the US, which exceed 100% of GDP. But this figure excludes the mountain of implicit debt created by local government financing vehicles, LGFVs, and state-owned enterprises, often borrowing against land or infrastructure projects. Imagine your credit card maxes out, but you still need cash, so you ask your friend Wang to borrow on your behalf. For the bank, it's Wang's credit, not yours. You then repay Wang, who settles with the bank. Local governments did the same. Before 2014, they couldn't borrow in their own name. They created LGFVs, urban investment firms backed by premium assets like land rights, to borrow from banks or issue bonds. These off-budget debts aren't in the official ledger, so they carry higher interest rates and murky repayment priority. In November 2024, after auditing scores of projects, China's Ministry of Finance confirmed 14.3 trillion yuan of recognized hidden debt. Of that, 12 trillion yuan is now slated for resolution via raising local debt ceiling by 6 trillion yuan over 3 years, letting authorities swap LGFV obligations into standard local government bonds, issuing 4 trillion yuan of special bonds earmarked for infrastructure or redevelopment projects to refinance hidden debt, repaying 2 trillion yuan outright with no fixed deadline, easing immediate repayment pressure. In essence, it's a debt swap and debt restructuring package. You borrow new, low-cost special bonds to replace expensive LGFV debt and extend maturities, trading short-term pain for long-term breathing room. The immediate effects are significant. Interest savings, LGFV bonds once bore double-digit rates, special bonds carry mid-single digits. Finance Minister Lan Fouan estimates 600 billion yuan in interest savings over 3 years. Easing triangular debt, complex intercompany debts in real estate projects often freeze payment chains. Fresh funding untangles these you pay me, I pay you loops. Market stimulus, converting implicit debt to explicit bonds pumps liquidity into infrastructure and real estate sectors, akin to targeted fiscal expansion without a massive new deficit. Many worry that injecting 12 trillion yuan will stoke inflation. Yet this program is mainly a swap, not brand new spending. The direct fiscal boost is modest. The real effect is in cheaper financing and extended maturities. Meanwhile, China's current inflation is tame, even below target, and some applause for moderate price rises. So don't expect runaway consumer inflation from this debt resolution alone. To understand why hidden debt ballooned, we need to see China's 4 books of government finances: general public budget, core revenues, taxes and expenditures, government-managed funds, special project fees, chiefly land transfer fees, accounting for over 80% of this book, state capital operations, dividends from state-owned enterprises, 0.7 trillion yuan in 2023, social insurance funds, pension contributions ring-fenced by law. The 1994 tax-sharing reform split revenue roughly half-half between central and local governments, but left local authorities with most spending responsibilities. By 2023, central government revenue was 10 trillion yuan. Locals had 11.7 trillion, yet local spending soared to 23.6 trillion, yielding a near 12 trillion deficit. In 2023, China's top tax sources, central plus local, domestic VAT, 1/3 of total revenue, split 50-50. Corporate income tax, 60-40 in favor of central. Consumption tax, 1.6 trillion yuan fully central, mostly on tobacco, oil, alcohol, and luxury items. Surprisingly, personal income tax is less than 7% of revenue, contrasting starkly with Western economies where it's often the largest source. In China, enterprises shoulder most of the tax burden, reflecting a production-oriented strategy. With spending outpacing revenue, local governments turn to land finance. They lease land use rights to developers at high premiums. LGFVs reinvested proceeds in roads and infrastructure, driving GDP growth and boosting future tax and land sale revenues, a virtuous cycle when property markets boomed. Post-pandemic property downturn halved land sale income from 8.7 trillion yuan in 2021 to an estimated 4.5 trillion in 2024, leaving LGFVs with servicing burdens they can no longer meet. This is China's fourth major debt swap since 2015. Early rounds, 2015-2018, moved on balance sheet quasi-government liabilities into explicit bonds, about 12.2 trillion yuan then. Today's program is the first to explicitly target hidden LGFV debt on a nationwide scale, signaling Beijing's resolve to bring transparency and control to local government financing. Debt resolution provides breathing room, but long-term stability demands, reforming LGFVs into market-oriented entities with clear governance. Diversifying local revenues away from land sales and enterprise taxes toward broader tax bases and user fees. Ensuring ROI on infrastructure so borrowing yields real economic gains exceeding interest costs. Ultimately, resolving debt is just step one. True fiscal health will come when local governments can fund public services and infrastructure without hidden liabilities, and when investment returns justify every yuan borrowed. That wraps up our deep dive into China's 12 trillion yuan debt resolution. If you found this breakdown helpful, hit like, subscribe, and drop your questions or thoughts in the comments below. We'll see you next time for more insights into global economic trends.